Topic focuses on option valuation and explains how options are priced and analyzed within derivatives markets. Options are derivative contracts that provide the holder with the right, but not the obligation, to buy or sell an underlying asset at a specified exercise price on or before expiration. A call option grants the right to buy the asset, while a put option grants the right to sell it. Because options provide asymmetric payoffs, they are widely used for hedging, speculation, and portfolio management. Understanding option valuation is essential because option prices reflect market expectations regarding risk, volatility, and future asset price movements. Option valuation begins with the concept of intrinsic value, which measures the immediate exercise benefit of an option. For a call option, intrinsic value equals the difference between the current underlying asset price and the exercise price when the asset price exceeds the strike price. For a put option, intrinsic value equals the exercise price minus the underlying asset price when the strike price exceeds the asset price. If exercising the option would not generate a positive payoff, the option's intrinsic value is zero. Options possessing positive intrinsic value are described as in the money, while others may be at the money or out of the money depending on market prices relative to strike prices. In addition to intrinsic value, options possess time value, which reflects the possibility that future market movements may increase the option's profitability before expiration. The total option premium equals intrinsic value plus time value. Time value depends on factors such as volatility, time remaining until expiration, interest rates, and expected dividends or cash flows. Longer maturities generally increase option value because they provide more opportunity for favorable price movements. Similarly, greater market volatility raises option premiums because larger price fluctuations increase the probability that options will finish in the money. Time value declines as expiration approaches, a phenomenon known as time decay. Several key variables influence option prices. The underlying asset price directly affects option value because call options become more valuable as asset prices rise, while put options gain value when asset prices decline. The exercise price also plays a major role because lower strike prices increase call option value and decrease put option value. Time to expiration generally increases both call and put premiums because of greater uncertainty regarding future prices. Higher interest rates typically increase call option values and reduce put option values, while expected dividends generally reduce call prices because dividends lower future stock prices. These relationships form the foundation of option valuation analysis. Volatility is one of the most important determinants of option value. Options benefit from uncertainty because larger potential price movements increase the likelihood of profitable outcomes for the option holder. Since option buyers possess limited downside risk but potentially substantial upside gains, increased volatility raises option premiums for both calls and puts. Implied volatility, derived from market option prices, reflects investors' expectations regarding future market fluctuations. Historical volatility measures past asset price variability. Analysts compare implied and historical volatility to assess market sentiment and identify potential trading opportunities. Volatility analysis therefore plays a central role in option pricing and derivatives risk management. The topic also discusses option payoff diagrams and strategic uses of options. Call buyers benefit from rising asset prices, while put buyers profit from declining prices. Option writers receive premium income but assume potentially substantial obligations if market movements become unfavorable. Investors use options to hedge downside risk, generate income, or speculate on future price movements with limited capital investment. Protective puts, covered calls, and spread strategies are examples of common option applications. Because options provide leverage and asymmetric payoffs, they allow investors to customize risk-return profiles more precisely than direct investment in underlying assets alone. The no arbitrage principle and replication concepts are fundamental to option valuation. Option pricing models rely on constructing portfolios of underlying assets and risk-free borrowing or lending that replicate option payoffs. If the replicated portfolio and the option produce identical future cash flows, they must possess the same current value under no arbitrage conditions. These principles form the theoretical basis for widely used option pricing frameworks such as the binomial model and Black-Scholes model. Although the program introduces these concepts at a foundational level, they remain central to modern derivatives valuation and risk management practices within financial markets. Topic ultimately demonstrates that option valuation depends on the interaction among intrinsic value, time value, volatility, interest rates, and market expectations regarding future price movements. Options provide flexible and powerful tools for hedging, speculation, and portfolio enhancement because of their asymmetric payoff structures. Understanding the factors influencing option premiums and the principles underlying valuation models enables analysts and investors to evaluate derivatives more effectively and manage financial risk efficiently. Mastery of option valuation concepts is therefore essential for understanding derivatives markets, implementing sophisticated investment strategies, and analyzing market expectations within modern global financial systems.